Hello, my name is Bruce Dueck with Keller Williams Realty, and I'm here today to share with you information for investors who are interested in investing in the real estate market and who are curious about lending opportunities that are available for investors. I've been in real estate for a number of years and been a resident in Northeast Florida for over 50. And I think this topic is particularly interesting right now because the rental market is so strong all across the country, but especially here in Northeast Florida. And there are great opportunities out there for investors or individuals who are thinking about becoming investors to try and build personal wealth. This is a great way to get started, to buy an additional piece of property, and to grow your personal wealth. If you're just getting started, we can help you out there. But today I'm very pleased to say that we have with us today an expert in the field of lending, Shay Peck, a graduate of Duquesne University, has been in the lending business for close to a decade. And when she started in lending, she just shot right to the top. She became a loan officer within a year and started her career up in West Virginia, but has been in Florida for the last several years. And she's just an excellent person to work with, very competent and capable individual. So I'm very pleased today to introduce to you Shay Peck with Bank of England, who's going to speak to us and speak to those who want to be investors or buy investment property here in Northeast Florida. So Shay, take it away.
Thank you, Bruce. All right, let me get started here. I'll go ahead and get my screen share going so that everyone can see what I see. All right, so basically, as Bruce said, what we're going to go over today primarily are, investment property loans, how those work and pretty much the basics behind that. So first and foremost, the overview. On an investment property, we do look for 20% down payment required on those. You do see a pricing improvement as far as your rate when you're putting down 25 to 30%. Some investors entirely will require 30. It just depends on who you're working with. When you are starting to look at credit scores, this is also impactful to the product because the higher the credit score, the better rate you're going to be looking at, and that's on pretty much any type of property, but it's super specific when we're looking at investment properties. Ideally, we want to see 700 and above, really to get you in a place where you're not going to be like paying points to buy down your rate or anything like that. It's more ideal, to have it in that 700 zone when you're looking to look at an investment property. And then rates, just as a rule of thumb, are higher on an investment property than they are on a primary residence or on a second home. And that's just by, the risk of default. So if something were to happen and a buyer owns a primary and they own an investment property, if anything were to happen, their first thing they're going to do is pay their primary mortgage. The investment property is probably going to be the last thing that they pay on. So that's sort of the risk assessment that banks look at when they price investment properties and why investment properties are actually priced higher as far as the rate. So another thing that is required on investment properties that you don't necessarily see on a primary purchase is reserved liquid financial assets. They are required, and it's usually a minimum of 6 months required per property. So underwriting is going to want to see enough reserves in the bank to cover your principal, your interest, taxes, and insurance, and including HOA dues if that's applicable. They're going to want to see 6 months of that total PITI in liquid assets or available liquid assets, which we'll get to, some of those examples. But, depending on the property type itself and the risk associated with that loan and profile entirely, sometimes you might even see someone requiring 12 months of liquid assets and reserves. And then acceptable reserve assets per Fannie Mae are checking and savings, investments in stocks and bonds, mutual funds, etc., and vested amount in retirement. So basically, they're looking for easily accessible money in the event that you have to, something happens and you need help with that payment. They want to know that you have those reserves on hand. With the debt to income limit, this will vary just depending on the credit score and overall credit risk entirely. And, this is sort of like the name of the game on investment properties. So, depending on the overall risk and the credit profile itself, the debt to income limit could be anywhere from 45% to 50%. And that just depends on the automated underwriting findings and the overall risk assessment on that loan itself. So a lot of people ask when they're buying an investment property, hey, can I have a co-signer or a co-mortgager on this property? A lot of people, either family members or two friends, will want to buy an investment property together. And yes, you may have a co-borrower on an investment property. It's, a lot of people look at doing that with either not just necessarily as a business, but just as a friend and someone that they want to look into an investment property, maybe out of town. In order to get a rental property going, sometimes people start out doing that with co-mortgagers.
Shay, can I ask a question here real quick?
Absolutely.
So what do you call investment property? Is that single family or single family up to 4 units, or is that what's typical?
So you can do 4 units. And an investment property in itself is just defined typically as what you plan on renting out. You do not plan on occupying it as a residence. You don't plan on occupying it 6 months out of the year. You only intend on using it as, a rental property itself. So you can do up to 4 units, and some people will buy like a quadplex, and then they've got, 4 renters in there, and you've got that income. So it's definitely a good option to look at if you're in the investment market. So really just to recap, there are a lot of positive aspects to purchasing an investment property. Like I was saying, the additional income, commonly referred to as Schedule E income on a tax return, just being able to, starting with your first investment property. And sometimes after someone has had their first investment property, then they start to think, oh, this is my thing. So they start looking at getting more and acquiring more over time. And obviously in doing so, you are expanding your portfolio, you're able to make more income on those properties. But with that also comes some, either hiring management to take care of those properties and making sure that you're still keeping them good for the renters and tenants in there. And investment properties in general, when looking at financing them, are a little more complex than a primary residence or even a second home because, like I was saying earlier, it's a riskier product for the bank to take on. So we do look for a little bit more in assets, a little higher credit, and things to sort of support the fact that, hey, I'm going to go out and I'm going to buy this investment property. I'm not going to live in it, but I'm going to rent it out. So, we want to make sure that you are committed and able to purchase that and make sure that, it wouldn't go into default or have any issues with that.
Okay.
And that's pretty much the total of it
So
in a nutshell.
It's very much like regular residential lending, with the exception of the fact there's a little more down, slightly higher interest rate. From the bank's perspective, it's the same sort of thing, except they're trying to manage their risks, so they cover that through the additional interest rate and additional information and maybe some reserves. So it doesn't seem like
the process is the same, and the time of the process is even the same. It doesn't add any extra additional time to your loan process, or it shouldn't.
Okay, is there a limit to the number of investment properties somebody can buy?
It does depend on who you're looking at, Fannie and Freddie. So one will only allow 4 mortgages, and that's a difference too. It depends if you have a mortgage on the property or if they're owned free and clear. So as far as mortgages go, one allows for 4, one will allow up to 10. But those are actual having mortgages on those rental properties. If you have them owned free and clear, the bank, we don't care as much on those. We're worried about the ones that you're financing in total.
So one can get into this as a way to expand the business opportunity for themselves. And then as they do this, when you have a business, of course, there's a lot of expenses that you can run through the business to help make your business more profitable. Very good.
Right.
So this is excellent information for anybody who is an investor or is thinking about becoming an investor. Particularly, some people coming up after they've got their first home, they're early in their career, they may want to do this as a means to help supplement retirement down the road. And I know a lot of people have done this and built wealth over the years through this approach. So Shay, thank you
Absolutely.
very much for this. This is great information. The other thing I would say is, for anybody who's interested in getting started, feel free to reach out to Shay or myself. Shay will get you pre-qualified. I can help you find that first property that you're looking for, and we could start searching on something today. We are your resource here for you, and we appreciate you watching. We appreciate the questions that you guys provide us, and that's why we do these videos, to answer your questions. So thank you very much for watching. You take action today. There's no time like the present to get started, and we are here as a resource for you all. So thank you very much.